Welcome to the deep dive.
Yeah.
We're tearing into a really valuable source today. It's the examiner's report for a recent sitting of the UK Advanced Taxation exam, ATX UK.
That's right. And this isn't just, standard feedback. It's basically a direct window into how the markers think, showing you exactly what works and, what doesn't in that high-pressure tax exam environment.
Absolutely. So our mission today is to unpack the really crucial insights, spotlight the common pitfalls, the traps people fall into, and just extract the most valuable lessons from this official feedback. Think of it like getting insider tips straight from the source.
Yeah, give you a shortcut, sort of, to understanding what mastery looks like in ATX. It's all about learning from the collective experience and maybe the missteps of a whole group of candidates.
Exactly. And we've got a clear path through it all. We'll start with the general stuff, the overarching strategies the examiner really hammered home, things that apply right across the paper. Then we're going to dig deep into the specifics. We'll pull out the detailed feedback on common mistakes and, successful approaches seen in questions about individual tax. Things like gains, losses, IHT, the remittance basis, and also corporate tax.
Yeah, covering things like capital allowances, those tricky overseas issues, group relief, that kind of thing. Ready to see where candidates did well and, maybe more importantly, where they stumbled.
Okay, let's unpack that general advice first then. The examiner laid out some sort of fundamental principles for tackling the paper. What really stood out in that general feedback section?
Well, the report strongly emphasized that solid, accurate knowledge is just non-negotiable. That's the baseline. But importantly, it wasn't just about knowing the ATX syllabus cold. You must bring forward knowledge from the basic UK tax syllabus too.
Ah, right. So you can't just ditch your earlier learning. It all stacks up.
Exactly. Those fundamentals are the bedrock.
Okay. What else did they highlight about preparing?
Question practice. And not just, churning through questions, but using past papers strategically, really using them to understand the style and the presentation of the exam. Yeah. And crucially, learning to spot those specific clues or triggers in the question wording, the things that signal, they want this rule here. It's like decoding the exam's language.
Decoding the language. I like that. It's not just knowing the rules. It's figuring out which rule they actually want you to apply right then.
Mm-hmm.
And then, okay, you think you know the rules. What about answering the actual question asked?
Yeah, that was another massive point. Candidates must address the requirement carefully. Only answer what's asked. Pay, like laser focus to the command words. Calculate, explain, advise.
Right.
Marks are strictly awarded for satisfying that specific requirement. Avoid just dumping general tax knowledge or writing long introductions unless they're specifically asked for. Get straight to the point for the scenario.
So precision and relevance.
Mm-hmm.
No showing off stuff that isn't needed.
Yeah.
And time management. Always a classic.
Simple, but still absolutely critical. Allocate your time strictly based on the marks for each part. It sounds obvious, doesn't it? But under pressure, it's so easy to get bogged down on one section.
And the age-old advice about showing your workings, still important.
Reconfirmed as vital.
Yeah.
Always show your calculations. The examiner reiterated that method marks are available. So even if your final number is wrong because of a slip, you can still get good marks for showing the right method, the right steps.
That's such a relief, knowing your process can save you, even if a calculation goes adrift. Was there any specific advice for candidates who might be resitting the exam?
Yes. For those coming back to it, the report advised really focusing on identifying and strengthening those weak syllabus areas, maybe using their previous feedback. Keep practicing past papers, obviously. Pay close attention to time management, and crucially, make a real effort to earn those professional skills marks sprinkled throughout the paper.
Okay, that gives us a really solid overview of the general approach. Now, this is where it gets really interesting, the specific feedback, question by question. Let's dive into question 1, the one featuring Lucia. A hefty 50 marker covered a mix of things.
Right. Question 1 often blends professional skills with various tax calculations. The feedback on the professional conduct part was actually generally positive. Most candidates did manage to link the previous advisor's actions to breaches of fundamental principles like confidentiality and professional behavior.
Good to see that ethical awareness is coming through. Any specific slip-ups there, though?
Yes. One notable error mentioned was some candidates seemed to answer a completely different ethics question. Maybe one they'd prepared for rather than the specific one in the scenario. It just reinforces that point about reading the requirements so carefully.
Absolutely. Okay, moving into the tax calcs within Q1. How did people handle the chargeable gain?
Calculations for the holdover gain were often, reasonably well done. It showed candidates understood the mechanics of that relief. However, a recurring issue, and we saw this across the paper, was missing the required explanations.
Oh.
You might calculate the gain figure correctly, but you also needed to explain why holdover relief was available or what its effect was in that context.
So the calculation is only half the story. Exploring the why or what it means is the other half. The report mentioned the post-tax income calculation was a real struggle point. Why was that?
Yeah, this section showed up several quite fundamental issues. Common errors included just getting the order of calculations wrong, mixing up income tax, NICs, dividends. Crucially, many missed, including employer NICs, were relevant. That's a basic point.
Right.
Or they used the wrong corporation tax rate, like applying the main 25% rate when actually the company's profits meant the 19% small profits rate applied. And errors with dividend tax, especially applying the nil rate band correctly, were also pretty common. It felt like maybe candidates weren't bringing that basic income tax and CT knowledge forward accurately enough.
Wow. So even in an advanced paper, getting basics like employer NICs or the right CT rate wrong can really, sink you. What about the trading loss relief for Lucia when she incorporated her business?
Most people correctly identified the standard options current or previous year relief against total income or gains. That was fine. However, fewer candidates knew about the specific rule that once the business is incorporated, that pre-incorporation loss can then be carried forward against company income she receives, like salary or dividends, under certain conditions.
Okay, that's a more niche point.
It is, but it was relevant here. And furthermore, many failed to do the final step, actually comparing the tax savings from the different options to conclude and advise on the best method for Lucia.
That's fascinating, connecting the individual's pre-incorporation loss to their post-incorporation income from the company. That link was missed, and VAT also popped up in Q1.
Yes, and understanding here was, shall we say, mixed. Some candidates knew about the capital goods scheme, but often missed calculating the actual unrecoverable input VAT amount. For the overseas purchases part, the better answers showed a clear grasp of postponed accounting.
Oh, okay.
And its crucial impact that it basically means no net VAT payable at the border, so no negative cash flow impact. But a really significant observation from the examiner was that it seemed like many candidates just appeared to ignore VAT as a syllabus area altogether.
Wow, ignoring a whole area seems risky.
Very risky, especially when it's specifically examined.
Okay, finally on Q1, inheritance tax.
Death estate calculations and applying agricultural property relief APR were generally handled reasonably well. People seemed comfortable there. However, a critical detail missed by many was explicitly stating why or when overseas property is excluded from the UK death estate calculation.
So again, not just knowing the rule.
Exactly. Not just knowing it, but articulating its application or non-application in this specific scenario. Why is Lucia's overseas property excluded if it is?
Right, explaining the why for the specific facts presented. Okay, let's move on to question 2, Commerce Ltd. A 25 marker focused more heavily on companies. Part A asked for the after-tax proceeds from selling some assets.
Yeah, this section highlighted several common calculation errors. Candidates often missed including the value of land when calculating the capital gain on a building, sort of confusing the treatment. They frequently failed to consider structures and buildings allowance, SBA, where it was relevant, or they incorrectly treated machinery disposals as capital losses instead of correctly applying the capital allowances rules, which usually results in a balancing charge or allowance. And a really fundamental conceptual error was calculating after-tax proceeds as gain less tax.
Instead of
the correct method. Sales proceeds less the tax on the gain. It's a subtle but crucial difference in the final number.
Sales proceeds less tax on the gain. Got it. That's a key calculation approach difference. What about the patent acquisition in Part B?
Okay, here, most candidates correctly identified the 75% gains group relationship between the companies, which, means a nil gain-o loss transfer applies. But interestingly, very few used the specific precise term tax neutral to describe this.
Okay, just a terminology point maybe?
Perhaps, but using the right terminology shows deeper understanding. More confusion arose regarding the future tax treatment of the amortization costs for the patent, and correctly applying the stated 4% amortization policy from the scenario within the tax computation itself.
Right, applying the scenario-specific facts again, shifting to overseas aspects for Commerce Ltd, taxing their overseas permanent establishments.
Many understood that, yes, the overseas profits are taxed in the UK, that's correct. but they often missed explaining why. The reason being, of course, that a UK resident company is taxed on its worldwide profits.
The fundamental principle.
Exactly. Candidates identified UK capital allowances could be claimed on assets used overseas, which is good. But they frequently missed key details, like the fact that annual investment allowance, AIA, could be claimed for vans, as they count as plant and machinery, and the critical point that only one AIA is available for a whole group of companies, not one per entity or one per PE.
That single AIA for a group sounds like a classic exam trap detail.
It really does. And better candidates showed a clear understanding of double tax relief, DTR. Particularly how it works when the UK tax rate, say 19%, is lower than the overseas tax rate, that specific calculation.
Okay. And the related question about electing to exempt overseas profits instead.
Well, the better answers recognize that in this particular scenario, probably because the DTR calculation resulted in little or no extra UK tax anyway, there was likely no current tax advantage to electing for exemption.
Right, because DTR already covered most of it.
Exactly. So marks were then gained by identifying the disadvantages of electing, like the fact it's irrevocable, and how it impacts using overseas losses or claiming capital allowances against other UK profits in the future. Applying those general exemption rules to the specific financial results and facts for Commas Ltd was really key for getting the higher marks.
It sounds like integrating those different concepts, DTR, exemption rules, group rules like the AIA limit, all within this scenario was a real challenge there. Okay, let's look at question 3, Danny. Another 25 marker, often involving individuals, employment, overseas aspects again. First up, remittance basis availability for Danny.
Okay, many candidates correctly identified that, yes, the remittance basis is potentially available for non-domiciled UK residents. That's the starting point. However, a significant number failed to properly explain why the deemed domicile conditions were not met in Danny's specific case.
The deemed domicile rules.
Exactly. Remember, deemed domicile kicks in if you were formerly UK domiciled and came back, or more commonly, if you've been resident for 15 out of the last 20 tax years. You had to actually look at Danny's facts in the scenario and explain why he didn't meet those specific conditions.
So it's not enough just to say he's non-dom. You have to actively show he's not deemed domiciled by referencing the rules and the specific facts provided. Okay. What about the benefit of the remittance basis? The report said many fundamentally misunderstood it.
Yes, this seemed to be a major point of confusion for, frankly, a large number of candidates. They missed really fundamental aspects of how it actually works in practice. Key points frequently overlooked included the basic fact that overseas income and gains are not taxed in the UK unless you remit them, bring them in.
Okay, the core principle.
The core principle. Also, that electing for the remittance basis means you lose your UK personal allowance. That's a significant trade-off. And the specific conditions under which the remittance basis charge itself applies, after you've been resident for 7 out of 9 years or 12 out of 14, it really indicates a gap in understanding the core mechanism for quite a few people.
Wow, that's a pretty fundamental concept to struggle with at the advanced level, isn't it? How about the share option and sales section, particularly regarding enterprise management incentive schemes, EMI?
Right. This section, looking at the tax consequences of EMI options, was actually generally well answered regarding the calculations and the basic principles, so that's positive. However, similar to Q1, many just provided the calculations without the required explanations of why a particular tax treatment applied. Why is there no income tax on exercise for EMI, for example?
The explanation again.
Always the explanation. And on the business asset disposal relief point, BADR candidates often correctly identified it was potentially available on the share sale. Good. But they frequently and incorrectly stated the main condition as needing 2 years of share ownership.
Which is the usual rule, but not for EMI.
Exactly. The correct condition for EMI shares is different. It's that 2 years must have passed since the options were granted. A subtle but crucial difference for EMI.
A specific nuance related to EMI that tripped people up on the BADR rule.
Oh, okay.
Finally, the inheritance tax exemption part in Q3.
Applying the normal expenditure out of income exemption and the annual exemptions, that was generally handled pretty well. Candidates seemed to know the standard rules there. However, a key professional judgment point missed by many was failing to state that further information was needed. To definitively confirm if the normal expenditure out of income exemption was fully available based just on the scenario facts, you often need more detail on income and expenditure patterns. You can't just assume all the conditions are met if the information isn't explicitly provided in the question.
So recognizing the limits of the information given and maybe stating what else you'd need to be certain, that's part of the skill too.
Exactly. It's about applying professional skepticism and, sound judgment.
So what does this all mean when we sort of pull it all together? This deep dive into the examiner's report really gives you a crystal clear picture, doesn't it, of the specific technical areas and application skills where candidates are doing well. And crucially, where the most common misunderstandings and errors happen at this advanced level.
It really drives home that success isn't just about, cramming rules into your head. It's about having that robust foundational knowledge, yes, but then being able to apply specific, often quite nuanced rules precisely to the unique facts of a scenario. And explaining your reasoning clearly, managing your time under pressure, and of course, showing your workings, showing your method.
Yeah. And thinking about all those specific points that were missed, like using the correct CT rate or the precise BADR rule for EMI shares, or truly getting the mechanics of VAT, postponed accounting, or explaining why deemed domicile isn't met, or even fundamentally understanding how remittance basis actually operates. What stands out to me is how critical it is to master both the broad concepts and the key details, and maybe most importantly, that ability to connect and integrate different bits of the tax system within one problem.
It's that synthesis, that application skill that really makes the difference at this level.
Definitely. So here's a final, maybe provocative thought for you listening. Given how interconnected tax rules clearly are, and how often these specific scenarios and subtle details can trip people up, even when they think they know the basic rule, how does tackling complex problems like these, like the ones in ATX, change the way you should think about learning any detailed interconnected system, whether that's tax or programming or even, a complex strategy game? Is the struggle with actually applying the knowledge to a unique context just as important, maybe even more important for true deep understanding than that initial effort to just learn the basic concepts in the first place? Something to think about.